Good morning. Welcome to today's session, Opportunity and Change. My name is Bill Bynan. We'd like to welcome you today for the third part of our series. Today, we're going to focus on liquidity and tax as it relates to our estates, and really dig into the impacts of the Biden tax change on our estate planning when it comes to these issues of liquidity in our planning. Really a new way to look at estate planning aside from just focusing on the tax. For those of you who know me, my name is Bill Bynan. I'm the CEO of Capital Wealth Advisors, and we are a private wealth advisory firm here in Naples, Florida, that serves families around the country in the areas of their planning and their wealth management. As a firm, I'm happy to lead a team of over 40 professionals. We have great team members that provide wonderful work for our families. We focus in the areas of estate planning, risk management, investment management. We do our own research internally. We have a wonderful research team on the investment advisory, focusing on our wealth advisory business, as well as serving families in the capacity of family office from an administrative perspective. Today, we're gonna wrap up our three-part series. And we're going to, as I said earlier, we're going to focus on liquidity planning as it relates to estate tax. It's really a new way to look at estate planning, understanding our options that we have for our unified credit if we didn't utilize that in 2020. Luckily, we've started to see some movement from the Biden administration, and we may have opportunities that still exist. In our three-part series, we've covered so far how the proposed tax law changes will affect us from an estate perspective. In the second part of our series, we focused on IRA planning specifically and how the Secure Act, coupled with the new tax law changes, are going to affect us from an IRA perspective. And today, again, we're going to focus on liquidity and tax. So today, I'm going to do a little bit of a series recap. We're going to spend some time talking about unified credit planning, and we're going to look into how we perform liquidity analysis and apply that to our planning. And then we'll talk about our key takeaways today. So from a series perspective, we talked a lot over the last two sessions about the potential tax law changes. And just to recap and sort of refresh our view of these proposals that are out from the Biden administration, it actually has come out over the last few days. This is very topical, that this is the next item on the agenda, and details will be released in the coming days. But what has been put out so far is that President Biden and his team would like to reinstate the 39.6% tax rate for income for top earners. They would like to increase capital gains tax, increase it from 21% to 28%, with a graduated scale up to 39.6% if you have gains in a year of over $1 million collectively. Increase the corporate tax rate to 28%. It also imposes an additional Social Security tax up to 12.4% on income over $400,000. So basically what it's doing is it's uncapping the Social Security tax that used to be capped in our income level. So it increases substantially total taxation for high income earners. It does reduce the benefit in their proposal for itemized deductions of no more than 28%. And it cuts the estate tax exemption from current 11.7 million to 3.5 million, reducing the amount that can pass tax-free to families. And it also increases the potential estate tax rate, graduated from 45% up to 70% for those ultra wealthy families of $1 billion or more. It would, most importantly, in my view, one of the biggest impacts of this tax law is the proposal to eliminate the step up in basis or basis reset. And this would provide that families would have to pay an income tax on the transfer of their assets, or a capital gains tax on the transfer of their assets, on all embedded unrealized gain on their assets at the time the assets transfer at their death. So really a second transfer tax. This graph, I love this graph. It kind of gives us a little view of the differences between the current, which were established on the Trump administration, and the proposal that is out from Biden. So you can really see the dynamic difference from a tax perspective. When we think about the potential impact that these proposals would have on estates, the key pieces that we've mentioned, the unified credit. Obviously, the unified credit is the amount that you can pass tax-free at your death. And again, today, that number is 11,700,000 per individual. So if you're a married couple, you each get 11.7 million. That is projected or proposed to be reduced to 3.5 million per person. We really rushed as we came into the end of 2020 to utilize that with the thought that the tax changes would be retroactive to January 1 of 2021. Happy to report the Biden camp has come out and said that more than likely that they are not going to push for retroactive tax effect, and that these potential taxes, if passed, would take effect beginning in 2022. That is very, very good news for families that haven't had an opportunity to complete their plan or didn't get things set up the way we wanted to last year in the rush. So I would encourage all families as we go through this process, don't wait. Begin the planning work now, because as we saw last year at the end of the year, it was a mad rush to get assets transferred, and it caused a lot of logistical issues, both from your legal and accounting teams, your advisory teams, as well as the custodians moving assets in a timely fashion. So very important to do that. The second major item from an impact perspective is the capital gains tax that could be levied through the elimination of the step-up in basis. So under the current law, at the time of your death, your basis resets to the value at the date of your death, eliminating embedded capital gains on assets when left to family members. In the past, there have been proposals to eliminate the step-up in basis, but where this one differs is in the past proposal, the step-up in basis would have been levied at the time that the assets were sold. Under the current proposal, it's more of a Canadian style system that they would be due upon the transfer of the assets. So if you think about it, you would have an estate tax from a transfer perspective, and then you would have tax on the embedded gain as a second transfer tax. So important to think about that. Analyze your family assets to determine what your real basis exposure is from a capital gains tax. So we want to make sure we look at that. And in general, capital gains taxes, when we think about them, if you have them $1 million or more, it could throw you into a 39.6 bracket from a capital gains perspective. So we want to make sure that we're looking at that and managing that. And there's some things that we can do along the way to kind of help lessen the impact of that. So from a tax implication standpoint, I always like to show sort of history. So where are we in relation to history? So as you look at the blue line that sort of comes across, you'll see that's the tax rate. And with the exception of this dip that happened in 2010, where we didn't have an estate tax, the rate has historically been around 50%. So the Biden plan kind of brings it back to more of an historical rate perspective. Also, if you look, we've had substantial increases in unified credit, really starting in sort of the early 2000s and rising, and where we are today is really different than it has been historically. So with that $3.5 million proposal, it does bring it back into a more of an historical rate perspective and an historical perspective with regard to the unified credit. It doesn't necessarily mean that that's correct. History has not indexed those unified credit values over time. So the reality is it is very impactful from an estate perspective. So 2021 and beyond, unified credit planning. The unified credit right now at 11.7 is projected to sunset back to 5 million in 2025, but the Biden proposal will sort of accelerate that and kind of lock in a lower rate. So the proposal to take it to 3.5 million would supersede the sunset provision, and it would begin in 2022. So anything that you've used prior to 2022 in this example would be locked in. So we want to make sure that we consider all of the gifting and all of the planning options that are available to us between now and the time the law is enacted in order to lessen the burden of this estate tax. And we're going to go through several opportunities today that give us an idea of things that we can use, how to structure it, how to build in some safety nets to that. I'm going to walk you through how it works. And it's going to give you an opportunity to give an asset to a spouse, apply the unified credit to that, but at the same time still have access to it. With this impending change in the tax law and also some nuance around the planning, which I'll explain, a new version was created last year to enable us to have even an additional piece which we can use in the event that we make a gift during this year and the law is retroactive, that we need to unwind it. And that's taking that that spousal trust and adding something called a special power of appointment that gives you a second trigger or lever to pull in the event that we need to make an adjustment after the fact. I'll walk through that. We have executed these for literally dozens and dozens of families. Feel very strongly about the opportunity and how this affects the planning in a very good way. So this method allows us to take full advantage of unified credit while maintaining control and access to the assets. So I have a husband and wife in this example. They each have 11.7 million of credit, and we're going to ask them to give it to each other. We're going to create trusts to be the recipient of those gifts. Now, key point to keep in mind, the trusts cannot be identical. They have to be substantially different so that we don't have something enacted called a mirrored trust doctrine, which would say that if the trusts are identical and they're reciprocal gifts, it's like you made no gift. So when we're working with your law firm, there will be some slight difference to them. They don't have to be major, but slight differences so that they are different enough not to be included in that the negative aspect of the mirrored trust doctrine. So in this example, we create two slats. Husband and wife fund each other's slats with 11.7 million of assets, and they can be any asset with the exception of retirement plan or IRA assets. So these have to be non-qualified assets. For the trust that was funded for the benefit of each of the spouses, you'll see that they each are their own trustee and they're also the primary beneficiary. So that if I funded a trust for the benefit of my wife, she would be the first and primary beneficiary for health, welfare, maintenance, support, education, also called the HEMS standards. Allows her to take income from that trust. But if she doesn't take money from that trust, the corpus plus the growth would then pass on to our beneficiaries, children, grandchildren. And I have a similar trust where where in this example, the husband controls for his benefit with the same idea. So when we look at this type of planning, we're able to give it to our spouse, continue to have access for that, getting those assets out of the taxable estate, but knowing we have access for income. So at some point, if we have a situation where we need the money, each of the spouses could access that. It's very important as you're doing this tax planning to also pair that with really a basic financial plan to stress test the need for income and assets for your daily life and well-being and spending and your budget. The reason I say that is in this example, in the event that I lost my wife in this example, her trust would pass to the beneficiaries at that point, and I would lose access to that. So if there was a situation where I may need that excess 11.7 million as a spouse, I need to do a slightly different type of plan. So when we're looking at this unified credit gifting, we always want to pair it with an analysis to make sure that we as a group and you as a family feel comfortable with the money that you have access to and making sure that it's not going to affect your lifestyle. The last thing I want to do is give you the best estate plan in the world and have you hate me 10 years later because you've given all your money away. So we really like these aspects where we can have some control and access to them. So one of the ways that creatively a law firm here in Naples put together, Wilson & Johnson, George Wilson, came up with an idea to kind of solve that problem. And he calls it a SPAT. And it's basically, it's a spousal trust that has a special power of appointment. So in the example that I just gave, the trust looked very similar, except it has some very special language in it. So in that example, if I lost my wife in that example, the trust would continue on and there would be a special power of appointment held by an individual that would allow me as the spouse to have access to that money on a periodic basis in the event that I needed it. So it basically allows us to keep it as a safety net. If I'm certain at that time I don't need the money, it can go down to beneficiaries, but it allows us to access. It eliminates the problem that we had with regard to that loss of use in the event of an untimely death of a spouse. So that's why it was created, but we really came up with sort of a secondary use to it. So hypothetically, let's say tomorrow you come into my office and we fund these two trusts with the thought in mind that these tax changes are not going to take effect until 2022. And let's say time goes along and now we're in the summer months. the tax legislation is enacted and they make it retroactive to this year. So we don't want to incur a gift tax because you've given away assets that weren't available at the unified credit. So that special power of appointment also gives us a safety net for a 9-month period of time to unwind the gift in the event that we have an adverse tax legislation. So it gives us the ability to go ahead and do the planning so that we're not rushing at the end of the year, knowing that if some unforeseen circumstance of legislation comes out that causes it to be a negative, that we can back out of that. We've seen the use of this actually this year, where we've talked to some people that had a situation where they accidentally overfunded their trust over the 11.7 million. And in a normal world, if this special power of appointment didn't exist, they would owe a gift tax on that overage. But because the power existed in the trust, we were able to back those assets back out of the trust, keeping it topped off at the 11.7. So it's a really good safety net to have. But for the current environment that we're in today, it gives us the opportunity to work on the planning now, have things in place so we're not rushing at the end of the year. And if, again, unforeseen legislative circumstances come to be, we'd be able to unwind that. So very important to think about. If you haven't used your unified credit, this is one way to take advantage of it. There are others. We'll talk about one other in our discussion today. But really important to consider using that, because if it goes to 3.5 million, your unused credit goes away, and that potentially could impact the family substantially from a tax perspective. Oops, sorry about that. Let me go back here. So another law firm in town, a friend of mine named Brad Galbraith, very, very great estate planning attorney, as is George Wilson. He has a different nuance to sort of create a plan that enables families to give assets away, but have a string on them for the purposes of this potential tax implementation, whether it's retroactive or going forward. And he uses a sale to an intentionally defective trust. Now, intentionally defective does not mean that the trust is broken or you need to return it. It really means that the trust has the ability for us to pass the income tax back to the grantor. So I'll walk you through how it works, how it's applied with this gift idea, and how it would work if the tax law is retroactive or if it's going forward. So basically, a family takes assets of any kind except for qualified assets. They sell those assets to this irrevocable trust, and they take back a note. And that note typically has a term, and hypothetically that term's 9 years. And over the 9-year period of time, the terms of the note will take cash flow from the assets and provide those paid back to the lender, the family. And there's interest, and there's also principal potentially, however you structure that. Key to note, any income tax that's derived inside the Idit, as they call it, is passed back to the grantor. So you're picking up the income tax on the assets in the trust. Why that's important is that the growth plus the tax value that you paid actually will be tax-free for your family at the end of the term of the trust. So each year there are payments that come back from the assets, funding back to the family. There's an interest rate applied to that. And then again, any income tax liability also flows back to the family. At the end of the day, after the note is paid off, or in the example, if they were to pass during the term of the note, the amount that's left on the note will be subject to estate tax. The balance would go tax-free, state tax-free to the family. So it's an interesting way to transfer growth of assets outside the state. So how do we use this in this limbo time with regard to making a gift for our credit, but yet having the ability to unwind it? So what we've done is we said, if the credit is still available and I want to complete the gift, and let's say it's 11.7 million of assets, in December, I can forgive the note and deem that a gift, using locking in the unified credit, getting the entire amount and the asset out of the estate. So this is, again, for somebody that doesn't necessarily need it for their spouse. It's really for someone trying to move things downstream, but it is a great way to do it. In the event that the tax is made retroactive, we just continue it as the traditional sale to defective trust, which has benefits in and of itself. So you really have that ability to capture the credit if the tax legislation goes as we think, But if it doesn't, we'll go the other direction, and we will cancel the note and move the assets downstream. So we've talked about locking in our credit. At this point, if you haven't used your unified credit, it's very important to consider it, because the likelihood or the probability of the credit being changed, in my opinion, is 100%. So if you haven't done that, we're happy to walk you through the planning. We're happy to walk you through our views. Even with the unified credit usage and all the tax changes, we're also facing a higher tax rate, lower credit, and this capital gains issue. So in the old days, we kind of said, and one of our clients always says his tagline is always "nothing spends better than cash," and he's right, and especially when you owe the IRS money for estate taxes. So over the years, we've heard my kids can live on half. I started with nothing. They're going to get more than I ever had. They can pay the tax and live on the difference. But the question is, will that really result in your kids getting half? And I'm going to walk you through a real case example of a family that we consulted after the fact. And I think it's important to look at the estate tax really from a different angle, and really looking at it from a liquidity perspective. And how do we apply liquidity analysis to tax analysis to really give a clear view? And it really, this also is applicable for smaller estates as well, because when you're dividing assets up, liquidity makes a difference. So there's applicability across estate sizes. So in 2018, there's a firm called WealthX, and they do a lot of data research on wealth globally. And it was really interesting is they looked at high net worth individuals over the age of 70, and they realized in this study that they only have an average of liquidity of about 38%. Interestingly enough, included in that liquidity are different types of funds that I call liquid but not liquid, so hedge funds and in a retirement plan accounts, because those are subjected to such a higher tax, and we'll talk about that. As you move, prior studies they've done, we get in your 80s, that number continues to fall. And if you think about it logically, you're living on your liquid assets in retirement, and your fixed assets are continuing to grow. Some families are in industry or business that, whether it's real estate development or things where a lot of their assets are illiquid. So important to keep an eye on that. But it is a trend that we see. And if you think about it, if I've got a 55% estate tax, I don't have enough liquidity in this example to pay my estate tax. So timing can be everything. I want to walk you through a case study as sort of our last piece for today. It's a real story, a real family. It is a very large family, but don't let that, think that this isn't applicable to you, because it could be just as applicable to a smaller estate. But I like this because it's actually a real story that I worked on. So we had a successful entrepreneur. He was a bit eclectic. He was divorced, had 2 children. His estate value was in the hundreds of millions. And his plan was, he was completely self-made. His plan was that he was going to, basically, his estate plan was pay the tax, kids can divide the balance, and they'll be extremely wealthy, which was the case, but you'll see how the plan didn't necessarily work out according to his view. When I say timing can be everything, imagine passing away in December of 2007, just at the tipping point of the great financial crisis. And in this example, due to the financial crisis, his liquid assets took a very large hit economically. He had a lot of asset classes, which I'll show you, that were down in value. And really nothing was immune. The federal estate tax was due 9 months from the date of death, so really at the peak of the financial crisis, so in August of 2008. So we put ourselves back in that time and thinking about how we can't plan the time of our demise, and we have to understand that we have to think about the what ifs when we're looking at planning. In this example, he had 80% of his net worth in illiquid commercial and residential real estate. He also was an art collector. And to sort of put salt in the wound, the majority of his real estate was located in Miami and New York City. So imagine those 2 real estate markets in 2008. They were 2 of the worst in the country. So imagine having to sell assets at that time to fund an estate tax. What was also interesting is I think he had 6 homes in 3 different countries, personal residences, and he had a lot of carry cost. So imagine your liquid assets are down by half, and now you're bleeding those assets for 9 months to carry the cost of his properties, employees, things that he had, and the children were not involved in the day-to-day, so they had a big learning curve as well. So you had a kind of a perfect storm. You had asset values as low, crashing. You had illiquidity, which was very much harmed during the financial crisis, and then you had a very large burn rate, eroding the liquidity that was left. In that example, in that example, at the end of the day, they couldn't sell assets. They had, as an example, they had an apartment, a very large apartment, half a floor of an apartment building on the Park in New York City, couldn't get a bid. Condos in Miami couldn't get a bid. Commercial real estate in New York City couldn't get a bid. And you also couldn't get lending on them. So they couldn't borrow against those assets at that time to fund the estate tax. What the kids had to ultimately do was they got a bank in New York to lend them money against the art collection that they had to sell off. They had to sell assets at huge discounts. And at the end of the day, they lost, I'd say between 85 and 90 cents on the dollar. So it wasn't just the tax. They were much more highly impacted because of the types of assets that they own. So when we think about estate planning, we want to think about not just the tax, but what are the assets? We have an analysis that we run for all of our clients that enables us to look at the estate tax with growth, and we overlay liquidity from that. So we can look on a year-by-year basis, net of your spending, net of your philanthropic donations, what does it look like, and how is that potentially impacted? And then we build plans to counteract the negative impact of that illiquidity. So take this scenario and imagine if we were in this future world of 2022, where we had a huge capital gains tax for any asset over $1 million, 39.6%. Imagine the exemption was $3.5 million. Dramatically would have been worse for this family. So the problems that exist in planning can be compounded by liquidity, but now they're going to be compounded potentially by additional estate tax, additional capital gains tax, higher income taxes. So it's a good time to look at your overall estate, provide a liquidity analysis, determine where you are, and then compare that against the family's goals. And how do we work through that? Liquidity can really be a number of things that you might not think about. So the easy ones are concentrated illiquid assets, real estate, operating companies that have expenses, private equity. Do you have carry costs in those? What is the 9-month cost to unwind the assets? Private equity is one that, as we've had low yields, a lot of people have gone to private equity investments. Many of those do not have a liquidity event at death. Same with hedge funds. If they don't have a death redemption, you need to look at those, because in 2008, all of those assets were locked up and you couldn't get liquid on them at all. But then I also take liquid, but not really liquid. So IRAs, as we talked about last week, are subject to a very large tax. Tax deferred assets, annuities, deferred compensation. In order to make them liquid, you're going to have a situation where you're going to be paying a large income tax. And unfortunately, under the new tax regime, any assets with large embedded gains are now not going to fall into the same plan. I was on the phone the other day with a family, has some concentrated stock positions. So how do we plan for that if we're not going to get a step-up basis? Because you're going to pay a tax to then liquidate the asset at a reduced price to pay the estate tax. So again, things to look at, especially looking at your estate plan. Do you have direct cash bequests? If you all remember the actor James Gandolfini from The Sopranos fame, unfortunately he passed at a young age, and his estate plan had an error in it. If you Google it, you can find it. But he basically it was in a second marriage, and he basically gave his first wife and children a direct asset bequest from the estate. A lot of the liquid assets went to them. His second wife received the balance, but they wrote the plan incorrectly, where at the end of the day, the cash bequest to the first recipients came off the top, and what the second spouse, and it was unintended, received was the illiquid assets, and the tax liability for the entire estate. So it really was just a mistake in the plan, but it ended up really harming her economically. So if you have direct bequests in your plan, we need to make sure that it's written properly so that we don't face some of those same challenges that we've seen in the world. If you have closely held businesses, important to look at those separately as a standalone. Even if the plan is to get that asset to a family member, you need to look at it as though a traditional buy-sell arrangement. How would that work in a real world scenario? Because you have estate balance and liquidity that happens if you have multiple children. So if you have closely held businesses, very important to look at those very specifically. If you have a blended family, which many people do, children from more than one marriage, how are they treated? How are the assets flowing? Do we have a situation where moving liquid assets one way, illiquid another way? So important to build that into the plan. And then unfortunately now we have to really focus on assets with embedded tax from capital gains, because that's going to have a dramatic effect on the way that we plan the estate. So as you're thinking about your own assets, your own balance sheet, it's important to think about these things, and we can take all the data and we can analyze what the potential impacts would be, so that you can have an opportunity to understand what planning advantage you may or may not have for avoiding some of those pieces. So again, important things to look for in your plan. So key takeaways for 2021. Again, we have a shifting political news cycle. The good news is it looks like we're going to push these into 2022. So we need to look at through this year, capital gains tax harvesting. Is there a value in paying some capital gains while the rate is low before it changes next year, which also helps you from an estate planning perspective? We can run that analysis for you. If you haven't used your unified credit, really consider making that an option in your plan. And I would say don't wait till the end of the year. Put it into a structure that gives you some flexibility to unwind it. And the reason I say that is last year, many people weren't able to get it done in time because they waited till the end of the year to get it completed. And you have to think about your professional team. Law firms can hit capacity in drafting documents. The custodians can have transfer issues if you're moving, real estate assets. There's recordings that have to happen. So don't wait. If you're considering it, start on it now. It's better to have it in place and ready with the opportunity to make an adjustment than it would be otherwise. So again, that's a scenario we saw over the years, this specifically in 2012 and again last year. So make sure that you're ahead of the game there. Maximize your gifting, your annual exclusion gifting. If you have an opportunity to do that, every dollar that you transfer out of your estate is going to save you the rate of tax. And if that tax is 55%, moving those assets annually really will help grow the estate off of your taxable page. And then as we talked a lot about last week, is review your IRA planning, review your beneficiaries, understand if you have those beneficiaries moving through from a trust perspective, and then consider alternatives to the traditional IRA transfers, the IRA max that we talked about last week. And from a perspective of planning, I think the key takeaway is get started. We're just at the end of March, but time does go very quickly, and we want to make sure that you have every opportunity to get the plans done in advance of where you are. Either I've been very clear of what I've said today, or you're slow asking questions. I did get one from Marcelo. Marcelo we were recognized today for being in Inc. magazine, fastest growing company. So thank you, Marcelo, for that. Our team works really hard, and we're proud of our accomplishments and growth in the firm. And it's really a result of our clients and friends like you all on the line today.
Hey, Bill, a question. This has been great, and it's a lot of information. For someone that's looking to come in, what should they gather together before that first meeting that'll be helpful? And then a second follow-up is, in addition to the planning, what can we do from the analysis of the existing investments to help out as well?
Yep. So first piece is typically we'll have a conversation before you come in. We can send you sort of a data gathering sheet with all the information. really the balance sheet, how you own it, portfolio statements, so that we can do an analysis on embedded gain, which was the second part of your question, and then also doing the liquidity analysis. So if you have an opportunity and you want to come in to talk about your personal situation, you can reach out through the system or send us an email at info@capitalwealthadvisors.com, and then we'll provide you the sort of data request in advance of the meeting, so that we can make the time more efficient. It's an easy process. Normally from there, we do a full estate analysis focusing on the tax, the gifting. We'll look at embedded gain, and then we'll look at liquidity. And then in addition to that, we'll look at your existing plan and identify any areas that we think should be adjusted to sort of help out with that.
Perfect. And then we had a question come in from Christine, who says, can you use the Idit to transfer amounts in excess of the unified credit?
Yes, the answer is yes. So when we look at that, many times the intentionally defective trust sale is used over and above the credit. In the example that I gave today, it was sort of twofold. One, it was for the purposes of locking in a credit where we could use the note of forgiveness as a credit equivalent at the end. But typically, when we think about it, a sale to a defective trust, GRATs, similar in result, it allows us to give an asset away. We're going to have a return of capital via the payment of the principal. So it's a great way for us to shift gain or growth of an estate off to into the non-taxable aspects of that trust. So yes, absolutely, it's a key strategy. We typically would, from a family goals perspective, if the goal is to do that, we would look at a few different ideas. Each one has certain nuances that may or may not fit with your family, but there are a few different ways to do it. And yes, wonderful plan. There are versions of the intentionally defective grantor trust that are more aggressive, where they, and I won't get into all the details, but where there's some discounting involved. The IRS has been a little vocal that they don't like that. They haven't stopped it as of yet, but you want to make sure that if you're entering in that type of plan, you're doing it in a way that matches your risk tolerance and understanding where the issues were. The example I showed today did not have any discounting, so it was really just a straight sale to the trust, which would move the gain off the plate. Also, a good time to do it now while interest rates are very low, because your hurdle rate is the interest rate. So if I can lock it in on the long-term interest rate the government puts out for these strategies, hypothetically, that's 1%. Growth over 1% is what gets moved downstream to the family.
Great, fantastic. And then we had a couple more questions come in. One from Jason, who's asking, should he hire his own lawyer to prepare documents like family partnerships, or do we provide them as part of our services here at CWA?
Yeah, well, we have lawyers on our team, but we don't practice law. So we typically will work with your team of professionals or help you identify and hire a team of professionals on the legal side for the document drafting. By way of process, we would work first on developing the plan and then engage the law firm as part of the sort of the execution of that plan is typically how we do it.
And then Kenneth asks, if your net worth is less than the current $11 million estate tax limit, is there any need for a significant estate planning at this point?
Yes. Estate planning is not only about the tax. First of all, if you think about the potential, it's going to go to 3.5, not understanding knowing what your size of your estate is. But let's say it's even below 3.5. Estate planning is as much about the disposition of the assets as it is the tax. And I actually, in many ways, think it's more important, because depending on your family structure or family plan, there will be structural things in your documents and in your plan that are very important outside of the tax. One, how are we leaving assets to children? Are we leaving them outright, or are we leaving them in ongoing trust that provides asset divorce creditor protection? We have many families, a trend, as our clients, luckily live long life, have long life expectancies, and as they age, many times we have a scenario where you have a wealthy generation one, but a wealthier generation two, and they say, hey, I want this money to go to my grandchildren. So really the family goals and the family structure. Do you have a blended family? What is your asset makeup? Even if you're below the unified credit level, do you have a family business where you have a state equalization issue? So all of those things are important to talk through, and extremely important to do that planning.
That's great. And then Andrew asks, what are the costs to initiate an interview and review from us?
So we don't charge for the initial review. What we do is it's our opportunity to earn your business and also determine if there is something that where we can add value. So the initial review and analysis is at no charge, and then we will build the cost structure based on the scope of building the plan. So we would do the analysis, meet with you, come up with sort of some ideas, and then say from there, hey, if you want to execute on these, this is the cost as you go forward. And then for our families that are asset management clients or wealth management clients of the firm, we provide the planning at no additional charge. So depending on if the question came from a client or not, I don't know who's on the line, so we do that. But we do standalone engagements as well if it's just for that.
Then a follow-up question, because a lot of this is generational planning. What do we think about bringing kids into the conversation? How should potential clients or potential people think about that?
Yeah, I find that it's family specific. I often say more communication is always better. We have some situations where they want the children to understand the plan, but not necessarily the amounts. So we customize those communications. We have some families where we host their family meetings on their behalf. We have some families that are fully transparent because their children are older. Others where they don't want their children to know exactly how much is in the family estate, but they want them to understand how it's all going to work mechanically. So yeah, we customize that. But I think at the end of the day, two things. One, the children understanding your desires from an estate transfer perspective. And then secondly, I also think it's really important for you to pass on to your children and grandchildren your views on money, your views on risk, your views on charity. I think the best family situations I've seen are the families that have talked through what the expectations of the matriarch and patriarch are. We have a lovely family that we've worked with 4 generations. We're now in the 4th generation of the family, and the thing that I always appreciated was the grandparents were very clear about sort of their family, what sort of charities they liked and how they viewed the world and how their expectations were. And it just has worked out really well because there's never a question to say, hey, what was the intent of this? They had an opportunity to tell them before they passed away, which I thought was really important. Well,
That's all we've got for our side. Yeah.
We've taken you a little over time, and I apologize for that, but I thought today was an important topic. I hope you found it interesting. Again, if you'd like to have an opportunity, feel free. You can email me directly, bill@capitalwealthadvisors.com. Our phone number's here. We'll be happy to walk you through anything if you want to come in. We're doing more in-person meetings now, but I had a meeting with someone from Buffalo the other day via Zoom, so we do it both ways. Happy to engage and talk to you about your plan, and hopefully we'll have some updates soon, because that means we'll have clarity on where the legislation's going. So keep an eye out for that, and keep an eye out for the news about the upcoming debate that we're going to have from our political leaders. So have a wonderful day, and look forward to seeing you soon.